The European Central Bank announces its decision on interest rates this Thursday at 12:45 p.m. UK time, with the usual press conference 45 minutes later. Will it announce any changes? What is almost certain is that at the press conference, at the very least, Mario Draghi may be asked about the reports that the ECB has discussed tapering its €80 billion a month bond buying programme. Let's take a look into some more detail now about what's happening and what's likely with Neil MacKinnon from VTB Capital. Neil, welcome. First of all, on the decision itself, the announcement at 12:45, you expect anything from the ECB?
Not really, along with the rest of the market. I think the ECB will keep policy on hold. As you say, there's going to be a lot more interest in what Mr Draghi says at the press conference. You mentioned the recent reports that suggested that the ECB might be considering tapering its QE programme, which is scheduled to expire March next year. And so that's going to be the key item, because many bond strategists were thinking perhaps the QE programme would be extended by 6 months. There was a feeling at the last meeting he might have announced that. He didn't. The report suggests that it's all going to be reviewed in December. But they are coming up against constraints, and they're running out of bonds to buy. So unless they change their self-imposed rules on issuance and issuers, which they can do, really as part of a overarching theme that's worrying the bond markets, financial market investors generally, is whether we have reached the limits of effectiveness of so-called unconventional monetary policies.
So what are the alternatives then? I mean, we've got to the end of the road on this particular thing. My understanding was initially it was only ever meant as a stopgap until the politicians got their act in gear and did something else fiscally. We haven't seen anything yet from politicians. Do you think the ECB has been let down, as indeed have other central banks, by politicians?
Well, I think that Mr Draghi would argue that is indeed the case, and in some of his recent speeches he said there is a limit to how much monetary policy you can achieve. There's a risk of it becoming overburdened. And of course, what we saw at the G20 meeting in China, what we saw at the IMF World Bank meetings last week, was that there's much more of a role for fiscal policy, fiscal activism, particularly on infrastructure spending. Good old structural reforms always make an appearance, although that's going to be very difficult with upcoming political elections. Policy tends to be on hold in that regard. But there is certainly a change in emphasis, switching away from monetary policy that looks as though it's being exhausted, certainly in the major economies, emerging markets. They can cut rates, they have room to cut rates, but there's much more of an emphasis on using fiscal policy as a way of stimulating demand and securing a sustainable economic recovery.
The sustainable economic recovery is one thing. The other question that's been pulled out now have been on basis of recent reports from Otmar Issing, one of the architects of the euro. Professor Issing was reported as saying that he feels that the ECB is becoming dangerously overextended, and he says, in fact, I think he mentioned, if the translation's correct, that he was talking about the potential collapse of the house of cards.
He did mention it being a house of cards, and I must admit I generally agree with Professor Issing, who's the ECB's first chief economist, and as you say, an architect of all of this. And I think we should not dismiss what he's got to say. There is a risk that the ECB's balance sheet, which has exploded in size and which now takes on board corporate bonds and as well as government bonds, is really reaching a level which could be quite dangerous, could be the road to debt monetisation. And of course,
just explain that. What is debt monetisation?
Well, it's basically printing money to finance a deficit. Now that's strictly speaking prohibited under the EU treaties, but of course what Mr Draghi has done in recent years has actually pushed back the boundaries, despite German concerns and in some cases opposition from the German finance ministry, who feel that he is going down the road of debt monetisation and taking a risk with the financial integrity of the eurozone itself. And so there are these problems. I mean, remember, there's no eurozone Ministry of Finance as such. It's not like the US Treasury or the Treasury here in the UK. There's no overarching fiscal authority, and indeed, one of the things that Professor Issing was talking about and other economists over the years have talked about is that monetary union will always be half-baked unless you have fully fledged fiscal union and banking union, because you run into these type of problems. So I think
there's no appetite for that at the moment in the current political climate.
Well, absolutely. I mean, I think that's right. And of course, what German politicians are worried about, given that there'll be an election in September next year, is that German voters are worried about all of this, that they'll either be there to pick up the tab to bail out everyone else, or on their own territory, Deutsche Bank goes bust and requires state capitalisation and all the rest of it. So you can see there are fracture lines everywhere throughout the eurozone. The banking system is undercapitalised. That was something the IMF highlighted in its financial stability report the other week. And so there are increasing pressures on the ECB. And it's why Professor Issing is worried about all of this, that actually the fault lines within the design of monetary union now becoming apparent, and that, you know, particularly with the vote on Brexit, that other countries, Italy, Spain, even France, might think, you know what, this hasn't done us any favours being part of monetary union. It's created low growth, high unemployment. We've had to cope with potential deflationary conditions. You know, this isn't really what we signed up to. So I think it's going to be a very interesting year ahead, but I thought Professor Issing's comments was something that we should take heed of.
Why hasn't the euro collapsed? Just as a final question, bring it all together and talk about the euro. The euro is holding up.
Indeed. I mean, I think the euro's holding up for a variety of reasons. One is that the eurozone has this rising current account surplus, which is German in origin. It's a major imbalance in the global economy. It's something the IMF has referred to. German current account surplus is going to be about 8 or 9%. It's quite amazing when you think that the Chinese surplus, which used to be at the centre of discussions with the US Treasury and all the rest of it, is a lot lower at 2.5%, something that the US Treasury highlighted in its currency report last Friday. But you know, this rising current account generates support for the currency. And of course, the last thing that Mr. Draghi needs as we go through this sort of nascent and fairly patchy economic recovery in the eurozone is a much stronger euro. Now, admittedly, in recent days, the story has been one of a firmer dollar as people, you know, think the Fed's going to raise rates in December. And that's taken a bit of wind out of the sails of the euro. But the real risk is, and we've seen it in Japan as a classic case, that if you're in a deflationary, low-growth situation, as you get more deflation, your real interest rate goes up, and then you find perversely and bizarrely that your currency goes up, which is bad news for your company sector, bad news for net profits, bad news for exports, and bad news in trying to get yourself out of a sort of a deflationary spiral.
Solution? Is there an easy one? Probably
There
not.
is no easy solution in all of this. I mean, I think it's quite worrying. You know, this is the house of cards scenario, not just for the eurozone, but generally, that ultra easy policies, you know, whether it's QE or zero rates or negative rates, is actually creating unintended consequences, creating the risk for financial instability, something that Stanley Fischer, the Fed vice chair, mentioned in the speech last night. So we could be in for a volatile and interesting time during the rest of the year.
Okay, Neil. Right, thanks there for joining us. Neil MacKinnon is global macro strategist at VTB Capital.